Good afternoon and welcome to the Pabrai Wagons Fund shareholder call. Before I begin, Aidan Townsend, our Manager of Investor Relations, has a few disclosures that he needs to share with all of you. Aidan?
Thank you, Monish. Good afternoon and welcome again to the Pabrai Wagons Fund Investor Call. We're glad you could join us. Before we begin, let us begin with the usual disclosures. Mutual fund investing involves risk, including the potential loss of principal. The fund is non-diversified, meaning it may focus its assets in fewer individual holdings than a diversified fund. Therefore, the fund is more exposed to individual stock volatility than a diversified fund. The fund may invest in small and medium capitalization companies, which involve additional risks such as limited liquidity and greater volatility than larger capitalization companies. The fund is new with limited operating history, and there can be no assurance that the fund will grow to or maintain an economically viable size. Past performance does not guarantee future results. Opinions expressed are subject to change, are not intended to be a forecast of future events, a guarantee of future results, nor investment advice. Fund holdings and allocations are subject to change at any time and should not be considered a recommendation to buy or sell any security. Now I'd like to hand the call back over to our portfolio manager, Monish Pabrai.
Thank you, Aidan. Well, good afternoon to all of you again. And we received quite a large number of questions ahead of this call. And I have to say that I was very impressed with the quality of the questions and the depth of the questions. I think we've got a very wonderful set of investors in the Wagons Fund, and I think they have an excellent understanding of some of our holdings and strategies and markets and so on. So that's wonderful. I decided I'll segment the questions into two different parts. There's a set of questions specifically related to portfolio positions. And then there's more general fund-wide questions. What I'll do is I'll try to select questions which I think have the broadest appeal. And I'll start with the individual names that people had questions on. And I'm going to try to go from kind of largest to smallest. In the meanwhile, the Q&A window is open and you can enter any additional questions you have over there. I am not sure how many I'll be able to get to, both that we received in advance as well as in the list, but I'll try to plow through as many as I can. So our largest position in the fund is Edelweiss, and I'm going to start with that. So one of the questions is, Edelweiss, your top holding in the fund, has delayed its IPO of EAAA to late 26. Actually, they've delayed it to April 26. Concern is not the delay, but rather the upcoming subsidiary IPOs are not demergers, but stake sales, unlike Nuvama, which was a demerger and a lot of money was made. So where is the value proposition in this stake sale? Because Edelweiss will become a holding company with a holdco discount, and investors won't get shares in the other businesses. That's a good question, somewhat detailed. So if we go back to the history of Nuvama, going back about 4 years, when it was called Edelweiss Wealth Management, at that time, about 4.5 years ago, Edelweiss owned 80% of Edelweiss Wealth Management, and they did a sale of approximately 40, about half their stake. So they took their stake from 80% to about 39%, and later had the option to raise it to 44%, which they did. So basically, PAG in Singapore came in and bought the stake from them and also bought out other minority investors. And at that time, if I'm just going off memory, Edelweiss received somewhere between $250 to $300 million for that stake sale. And then when the IPO took place, at which point Edelweiss owned 44% of what became Nuvama, they spun off 30% of the company to Edelweiss shareholders, and they retained 14%, which they subsequently sold off gradually. So in that case, there was a spin-off which the shareholders participated in. The story actually with EAAA, in my opinion, is even better. It's actually significantly better than Nuvama. So first of all, it is expected. So currently, Edelweiss owns 100% of EAAA, whereas they used to own 80% of Nuvama. And they haven't sold any stake to anyone. So their plan is to sell 15% of the company in the IPO. And it's expected that the market cap may be somewhere between a billion, $1.5 billion, maybe it could even be 2 billion by then because we have a delay. So let's say, between 1 and 2 billion market cap, EAAA goes public, they sell a 15% stake, they'll collect 150 to 300 million on their balance sheet. And I believe after that, what Edelweiss is going to do is similar to what they did with Nuama. They will spin off, first of all. So I think that they'll be left with 85%. And I don't know what percentage they'll spin off. They might spin off 40, 50, 60% of the company to investors after the IPO, similar to Nuama. And then the holding company may retain some stake that they may also sell over time, or they may keep some of it. I'm not sure. But I do expect that as shareholders, we will receive the spun out shares. And one of the things to keep in mind about Edelweiss is, like EAAA, we'll probably have 4 to 6 spin-offs come out in the next maybe 4 to 6 years. I would expect each one of them to have $1 billion or more in market cap. And I would expect each one of them to basically be spun off to shareholders. I don't know what percentage and all that, but I'd say a healthy percentage should come to shareholders. But one thing to keep in mind is that in 2021, Edelweiss had a market cap which is very similar to what it has today. Its market cap was under $1 billion. And inside that $1 billion, at that time, after they sold the stake and they had 44% of Nuama, that Nuama stake of 44% in 2021, today, Nuama has a approximately $3 billion market cap. So there was effectively at that point, future value of 1.2 billion just in Nuama embedded in the stock with a market cap under $1 billion. And we have a very similar situation today where Edelweiss market cap is maybe 1.1 or 1.2 billion, somewhere around there. The EAAA stake alone, I think, exceeds the entire market cap with no value given to all these other businesses that are growing quite spectacularly. So that's the reason it is our largest bet. It's the highest conviction bet. One of the things I just want to emphasize to everyone is that as you hear me talk about these companies in the portfolio, in general, you're going to hear positive commentary. But I also know that when I look at the entire portfolio, some of the names are not going to do what we expect them to do. In fact, if 50% flatline or don't do much, I would consider that par for the course. And if 50% don't do what they're expected to do, we would have home run in terms of results. And of course, if we had like 60 or 70% perform, then it would be beyond that. So please keep in mind that all of these things, because we're talking about equity investments, they can play out in ways that can be quite negative. So even though we have a high conviction in Edelweiss, nothing is for sure. Nothing is 100%. That's basically kind of how I look at Edelweiss. Basically, it's a situation, kind of set it and forget it. We need to be patient. We just, keep our stake. And our objective would be that if we can, we'd like to retain the EAAA stake. I like that business a lot. And when the other businesses come out, we'll kind of evaluate them. But many of them are wonderful businesses with a lot of tailwinds. So we're likely to retain many of them in the portfolio after the spinoff. And going on to our next highest conviction idea is TAV Airports. There's a question about net cash from operating activities dropped from 24 to 25. And how should we interpret this, etc. So I think one can't really look at TAV as a single business. It's actually like more than a dozen businesses inside a holding company structure. And to understand TAV, one really has to peel the onion on the individual businesses. And I think just looking at the overall, financials rolled up, especially with all the inflation accounting that I still don't understand in Turkey, is, I think, a fool's errand. I think you can almost draw no conclusions from it. I would just say that TAV currently has a market cap of approximately 2.4 billion. And when we look at some of the individual pieces, we just met with a number of business units in TAV in Istanbul last week. And I visited the Ankara airport, which they operate, and also the Bodrum airport, which they operate. So we basically had a significant deep dive on TAV, which we do every year, but we visited a number of their properties and met with a number of their leaders. But if you look at just one of their assets, which is Almaty Airport, that airport is likely to be producing in about 4 or 5 years something like 150 to 200 million a year in free cash flow. And if I go out about a decade, it could be twice that, 300 to 400 million a year in cash flow. Almaty is a very unique asset because it's owned outright. Only about 4 or 5% of airports around the world are privately operated, but almost all of them are BOT models, build, operate, transfer. So which means you get a concession for 10, 20, 30 years and you run it and then the asset goes back to the government and so on. But Almaty is owned outright by TAV forever. These are extremely rare. Heathrow is another example of an airport that is owned outright. There are just a very small handful of airports around the world that are like that. So if you take an asset like Almaty, if it were ever put on the market, and if it were put on the market, let's say in 2035, I would expect Almaty to have a bidding frenzy if they ever decided to do that. And I would expect it would go for well north of 10 billion, could even be 15 billion. And the market cap of TAV is 2.4. Almaty is just one of the assets. Havash, which is their ground handling company, probably has multi-billion value. Even some smaller pieces that they have, like TAV Technologies, is growing so fast that probably in 4 or 5 years is also probably worth over $1 billion. So you've got a number of different airports. Ankara is a total crown jewel airport. So I think with TAV, our perspective is that they have amazing properties. Probably by next year, they become a strong dividend player. The French company, Airports de Paris, that owns 46%, would like TAV to distribute half or more of its earnings. And I think by next year, their leverage will go down to a level where that will make it possible. So I think we should be seeing some very strong dividends coming out of TAV starting in 26. And we have no idea what deals they do in the future, but they have a lot of demographic tailwinds with passenger traffic numbers going up in almost all their geographies. So basically, TAV is one where we just want to sit and do nothing. And it's a good team, and we want to leave it there. Next, I'll go to metallurgical coal. You said before that AMR and Warrior are amongst the lowest cost producers of metallurgical coal globally. However, based on publicly available data, it's hard to reach the same conclusion. What quartiles do Alpha and Warrior fall into on the global met coal cost curve, including domestic China? Well, that's a wonderful question, and clearly someone who understands the met coal space extremely well. So when we talk about met coal cost curves, we need to limit ourselves to the seaborne met coal market. The seaborne met coal market has standardized grades like the Australian PLV, which has, it's a benchmark price, FOB Queensland, that a lot of other met coal gets priced off of. Domestic China, which is not seaborne in many cases, is lower grades of metallurgical coal in many cases. So it's really apples and oranges, and it doesn't really correlate with the things in our portfolio. So that's kind of a different animal altogether. But when we talk about the seaborne high-grade metallurgical coal, Warrior would clearly fall in the lowest first quartile, the lowest quartile on the cost curve. And when we look at Alpha is higher than Warrior because they're doing, room and pillar mining versus longwall. But this most recent quarter that Alpha reported, we were shocked actually and stunned, I would say, with the huge drop in their costs. And they took the cost down quite a bit. And I think it looks like it's sustainable. So they really kind of put everything under a microscope. So they're not as low as Warrior. Warrior actually has a huge advantage in transport as well because they're closer to the port. And they've got the ability to ship by barge, which gives the railroads much less kind of flexibility and power on rates. Alpha is much more at the mercy of the railroads, and usually something like 25% of the selling price of the coal up to a certain point goes to the railroads. And so basically, effectively, railroads are collecting a toll and on that. So it's a great business for them. But Alpha and Warrior, in fact, with Alpha, we were expecting with the extremely low index prices in the second quarter that Alpha would have a significant cash burn. And they had almost no cash burn, which was really stunning from our point of view. And their cash reserves are almost 2x the level that they want to be at. So we like both those bets. It's a demand story. It's not really a supply story. We need the world to get a little bit more back on track. The tariffs don't help the world getting back on track, but we don't know kind of how things play out. If the Ukraine war ends and we get a few other things which lead to a lot of activity in construction, then we can have some strong tailwinds on the demand side. But in the meanwhile, we like these bets, and I think probably in the next 2 or 3 years, we should see some good returns from them. Norfolk Southern UP merger really has almost no impact on them because they are really very regional in terms of how the shipping takes place. So I don't think it's going to have any impact on them. The river barge shipping, currently not much of an issue for Warrior. And Warrior really just, for the most part, uses a leverage against the railroads, and it does work. They do need water levels to be reasonable, but in general, they're also less congestion in Alabama, and so their costs are lower from that point of view as well. There's a question, do you have a subscription to Matt Waters' Coal Trader Substack? If so, do you use it for decisions or rely on your own analysis? Yeah, we met with Matt and we subscribe to his Substack, and we do listen, we do read it. I don't know whether we've acted on any information on it. He gets a lot of good data globally, and we like to keep up with that through him. I'll go to Reysas, even though it's a little smaller than our offshore drillers. There's a question, from your podcast, you mentioned not planning to own over 33% of Reysas across funds, including Wagons. Do you collectively exceed 1/3? If so, what's the impact on the Wagons fund? Yeah, so legally, we have no restrictions on how much Reysas we can own. Turkey actually allows foreign investors to come in and own as much of a listed company as they'd like. So there's no legal restriction. We sensed with the body language that the founders had possibly some discomfort with the very large size of our position. So we told them that when Reysas Logistics was a little under 33% for us, that we wouldn't increase it. That's just kind of voluntary on our part. We really don't want to have the managers and owners of the businesses we invest in to have any discomfort with us. And so we wanted to give them some comfort that we are passive and such. And so because we were at that ownership level, when Wagons Fund got going, it really had no Reysas stake because we were kind of limited. The Pabrai funds, my private funds, had to sell some of its Reysas stake to meet redemptions, etc. So it was going to be reducing its stake, and that created the room for Wagons to buy. There are two Reysas listed entities, Reysas Logistics, where we are at, a little under 33%, and Reysas REIT, where actually I don't think the promoters care, or the managers care how much we own, because 62% of that is owned by Reysas Logistics, so they've got control of that asset thoroughly. So we've been increasing our stake in Reysas REIT, and once we had reduced our stake in Reysas Logistics, we could basically take a position in both of them in the Wagons Fund. So Wagons Fund has an interest in both Reysas REIT and Reysas Logistics, and they're both significantly undervalued, very good capital allocators. And so we think that intrinsic value will rise over time, and hopefully the gap will narrow between intrinsic value and market value. Going to our offshore oil services, we have 3 bets in the space, Valaris, Noble, and Tidewater. So there's a question, if Valaris replacement cost is $25 billion, while the market cap is $3 billion, why not size the position larger? Well, we have to remember that replacement cost is a data point that sometimes may not be the important data point. For example, if I look at the Class 1 U.S. railroads, Union Pacific or Burlington Northern, Santa Fe, etc., to replace those assets is almost an infinite amount of dollars. In fact, they can't be replaced. You're not going to get port access to Long Beach or LA or some of the other major ports. So basically, transcontinental rail, a new transcontinental rail in the US, if it were to be built, it'll be just some ridiculous amount of money, many, many multiples of the market cap of these companies. But that doesn't mean that those railroads are going to trade at anywhere near those replacement cost values. In the end, all businesses, the real way they get valued is the cash they're going to produce from now till Judgment Day and then discounting it back. And that's the way Valaris is going to be valued eventually. So the fact that the replacement cost of the asset is high is interesting. It doesn't mean that it will trade at that value. It could even trade above that value, depending on how tight the market gets. But the bigger determinant of kind of how we do on these bets is not so much replacement cost as it is where we are on supply and demand, And it's difficult to imagine currently that any of these offshore oil service companies will ever place an order for a drill ship. That would be $1 billion plus order for a drill ship. To justify that, you would need 700,000 a day every single day in rates nonstop for 30 years to get a 12% return. And so since no one's going to give you a 30-year contract, I think it's very improbable that anyone's going to want to do that. Now, one of the national oil companies could place an order. I mean, their calculus is different. So you could have one of the majors or one of the national oil companies place an order for a drill ship. But if they do, you're talking about $1 billion price tag and maybe 3 to 5 years for it to be delivered. So the existing fleet of about 80 drill ships is unlikely to increase and likely to shrink. Currently, the utilization rates are kind of 85 to 90% in that space. Once we get solidly past 90%, we may see rates become much higher. But we're going to have an air pocket. I think best I can tell is that the industry is going to have an air pocket where that utilization rate might actually come down in the next 6 to 12 months. And the expectation is that about 15, 18 months from now, it'll start creeping back up close to 90 and then start maybe even going beyond that. So, I think that both the coal bets and the offshore bets are asymmetric in the sense that there are a lot of things that could happen that could lead to some incredible cash flows. And we could also see that weird things happen in the world and they kind of don't do what we think they'll do. So we think it's a very worthwhile bet because of the risk reward. We think that the prices we bought these assets at are very conservative. So we'll see how that plays out. Going to the home builders, when and why did you sell TriPoint Homes? Well, I would just say that basically the Wagons fund is approximately a little less than 2 years old. We didn't have access to India until almost like a year back. We were trying to get access, just took a while. And when we had the access and we made the Edelweiss investment and we made that a 20% bet, typically a lot of our bets are 4% bets. So that would take out 5 positions just to accommodate that. When we made the bet on the offshore drillers, which is another one we like, that needed 12% allocation. So another 3 positions go out because of that. So you get to now, 8 positions. And then when we add something like Reysas with another 2, that takes out about 10 positions. So it looks like we've had a lot of changes in the portfolio, but these changes came about because of kind of weird one-off things about the funds getting going, not having access, couldn't invest where it wanted to invest on day one, etc. But as we sit here today, we don't have any access issues. We can invest whatever we want, wherever we want, which is great. There's always things that could come up on the radar that look interesting, and then we do an opportunity cost analysis. So I know that the past portfolio changes in the fund have been quite a bit, mainly for this reason that we like those names, but we like the names that were coming in even better. But I would expect going forward that the fund changes will be kind of few and far between, because typically in a year, we're not able to find more than a couple of things, maybe 2 or 3 things at the most. So we don't have that much that we can make changes or add to, etc. There's a question about some exited positions like CCI, Coca-Cola, ISEC, and FS. Can you talk about your recent trip to Turkey? Has CCI FS management treated you differently since your exit, the post-Russian brewery takeover? And any additional Istanbul trip insights specific to CCI and FS? The managements of these companies have always been wonderful to us. They're very hospitable. They're very welcoming. We did not meet FS on this trip. We met with Coca-Cola, ISEC. And we had good meetings with them. We actually did a market tour where they took us to a number of different categories of outlets, organized retailers, small mom and pops, some kind of small restaurants, large restaurants, etc., to show us kind of how they were doing things. So I think we had a good meeting with them. I think there's nothing there that gets us excited to go back in versus what we have in our portfolio at this point. But we definitely, appreciate the strength of the brand. But there's a bunch of headwinds Kokal Isaac is facing in some countries because of Gaza. They're seeing very significant drops in volume in Bangladesh. They've also seen about 3,500 outlets in Turkey refuse to carry their products. They kind of associate Coke with US and Israel and so on. So they are facing kind of real headwinds, backlash on that front, which may not go away for a while. So we'll see. But we don't have a position there and we don't have any plans to take a position at this point. Brookfield Asset Management, what made you exit? Well, again, it was opportunity cost when we had those positions coming in. The same with Core Natural Resources. We prefer the pure met coal miners. And so we like the met coal mining names more than Core. Core has more diversified portfolio and some assets that we're not great fans of. So I think we like where we're at. A recent Eastman interview mentioned shorting some auto dealerships due to inventory dynamics alongside a Stellantis short. Any thoughts? Well, I think the auto dealerships are misunderstood by the market. I think from the Wagons Fund has some exposure to them. They are not our highest conviction bets, but we've held them for a while. We like the plays. And I think that what people miss in the auto dealerships is most of the action is in the back of the house with parts and service and used cars and also, F&I and all of that. So the straight new car margins approach zero. It's a commoditized product there, so they don't make much there. And that's not where the story is. But they make a lot on parts and service, which is very recurring because as cars get more complicated, dealers see more of them for a longer time. The US fleet is the oldest it's ever been. And then with the tariffs coming in and the increased price of new cars, that fleet may continue to get older and people will want to spend more money maintaining their cars. So I think it's good for the likes of AutoZone and those types of names, but it's also very good for the dealerships in general. So I think the car dealers they're good business and we like it. I think those were the questions I saw which were related to the portfolio. I'm going to go through some of the more fund level questions that I think may have some broad appeal. So there's a question: I would like to inquire about your assessment of your performance as a fund manager of the Wagons Fund. After careful reflection, how would you rate your performance? Would you consider implementing any changes to your approach? Additionally, I would like to understand whether your interests align with those of your investors in this fund. The Wagons Fund is less than 2 years old. Really kind of an inadequate time from my perspective, even though I may be biased to draw any conclusions. It's also been a period where the Mag 7 and the AI bets and all of that have been forming, and a lot of the smaller cap names, and you get past the top 20 names in the S&P and they're not doing so great. I think there will be a rotation at some point because eventually things change from a voting machine to a weighing machine. And so our portfolio in the Wagons Fund, I love the portfolio we have. I think that it's a wonderful set of businesses. My own history as an investor has informed me over the last 3 decades or so that many times the returns that you're expecting in the business don't even show up till you've held the position for 5 years or more. Many times we see that 5th, 6th, 7th year of ownership is when you're really seeing the dividends. And we didn't see, for example, Reysas, we've been invested since 2019, huge discount to intrinsic value. We saw no returns, no meaningful returns for the first 3 or 4 years, even though the discount was so wide. And that may be similar here, where we look at companies like Edelweiss and we kind of shake our heads about the valuation. And it may take, 2 or 3 years for that value to be reflected. But when we look at the portfolio as a whole, and then we look at kind of what is the likely intrinsic value of the portfolio, we see a huge gap. So I would say that I would not have expected us to underperform to the extent that we have in the first 2 years versus the S&P. But I would also say that since February or March of this year, we've kept up with the S&P approximately. So even though the S&P has been climbing, the Wagons Fund has, even with all the non-S&P bets, for the most part, kept up. And at some point, if the S&P takes a tumble or the broader market takes a tumble, our names may or may not do that. When I look at Turkey, for example, this time from the trip, it was very clear that business climate in Turkey is very anemic right now. They've taken interest rate, they took interest rates all the way up to 50%, and now they're in the 40 odd percent, but that has worked really well. Inflation has come down a lot. Inflation is like kind of 20 odd percent a year when it used to be close to 100%. And it looks like probably in 2 or 3 years, Turkey will have single digit inflation, which is really quite remarkable, and could have single digit interest rates. And that would, I think, trigger a very significant boom. So our Turkey bets have done reasonably well with all the headwinds that they're facing. They haven't really had tailwinds. So I think when the tailwinds come in, they could be very strong and such. So next few years, I think I'm very bullish, but obviously you have to temper it with my biases. How do you reconcile the proven strategy of running a concentrated portfolio with the mutual fund regulatory requirements that force you to diversify more than you otherwise might? How different would our long-term performance outlook be if we could be more concentrated? Similar to your private funds. I think the mutual fund diversification rules are good rules. If I were a regulator, I would want those rules. I wouldn't make much change to them. I think that when you're dealing with Joe Public and you're dealing with equities, I think diversification is very good. And at the same time, what we have tried to do is obviously we have to stay within the frameworks and be diversified, but we've tried to, because I can't come up with more than a couple of ideas a year, and the fund, is going to have 15 or 20 positions, is we've made multiple bets in a given sector that we like. In an ideal world, what I would have done is I would have picked the best of them to invest in. And here we don't have the choice to pick the best, but that's in a way that might also be good, that we may be wrong about which one is the best. And so, for example, we have 3 bets in the offshore drilling space, and we have 3 or 4 bets in the met coal space. And, similarly in the home builders, we've got 2 bets, car dealers, I think we've got 3 bets and so on. So we would have been a little bit more narrow if we were allowed to, but I don't have much complaint about the way it is set up. I think I like the way Pabrai Funds has some concentration. Like, for example, we have a large bet in Edelweiss and TAV Airports, and we have a lot of smaller bets, but I think they're in 5 or 6 buckets, and we like those buckets. How are trades prioritized between Dalal Street Hedge Fund and the Pabrai Mutual Fund? Will Dalal Street Fund trade in front of the mutual fund all the time? I'm concerned about the conflict of interest here. Yeah, that's a very good question. And we have a lot of compliance on the mutual fund side. We have a lot of compliance on the hedge fund side. And basically, for every single day of the year in advance, we basically have a set algorithm. So every 5th day, the Wagons Fund has priority, first fund to invest in whatever it wants to. And 3 out of the 5 days, our hedge fund, the 3 hedge funds have priority. So basically it's spread out. And from a practical point of view, not all funds are buying all the time. So sometimes when the Wagons Fund is building a position, it could be buying every day as the number one. So we don't think there's any preference that Pabrai Funds or the Wagons Funds gets in the buying. It's been kind of equitably set up. I don't really have any discretion, if you will. On a daily basis, it's dictated by what's been blessed by compliance, and we just do it that way. And I think it keeps our life simple, and I think it's very fair to everyone. Let me just see if funds there, and then I'll take a look at the questions on the chat window. The Pabrai Wagons Fund size is rather small, about 80 million, and order of magnitude less than Monish manages in total. Is there a threshold below which you close the fund or increase the fees due to a mismatch between fees and overhead at the current fund size? Actually, we are very happy with the way the assets have grown, especially with the headwind of underperforming the S&P. So we have no plans to shut it down. We like the funds. It will become profitable for us when the assets are around 150 million or so. And I think we'll get there partially organically and partially with increased assets. I'm not sure in what time frame, but I think it should get there. So we have no plans. We have no plans to raise the fees. As we scale, there are possibilities that the fees could go down, but we have no plans to increase it. Let me just take a look at the chat window to see if there are some interesting questions which may have broad appeal. There's a question on Valaris, which is one of our offshore services. Given Valaris's current contracting strategy, pursuing 2 or 3 year deals and structuring shorter contracts as stepping stones to longer ones, how do you view the trade-off between locking in visibility today versus retaining exposure to potentially higher day rates from 2027 onward? Do you see a risk that Valaris might sacrifice upside if much of the floater field already contracted past that inflection point? Well, I would just say that in the interaction we've had with Valaris management, I'm very impressed with them. I think they really understand what they have, and I think they take a very long view of the business. They have 3 cold stacked 7th gen drill ships, and they are not in a hurry to put those to work. It may take a year or 18 months to mobilize them when they get a contract. They are profitable, solidly profitable cash flow wise without these 3 ships. But if and when these 3 ships join the others, that's a very significant boost to their cash flows. And I think the way Valaris functions is excluding the cold stack ships, they do want to try to keep their kind of yield up. And so if a ship is sitting idle and they get a 3-month, 6-month, 1-year job, and they can clearly see that that would take away some slack, they'll do it while retaining, obviously, the flexibility to do a better longer-term deal. I couldn't do it better myself if I was in their role. I think these guys are really experts at this, and they do a very good job, and they do not have balance sheet pressure to do stupid things, which is great. There's a question on Edelweiss, looking at Edelweiss frequent management exits, especially with Venkat leaving. Secondly, on Edelweiss, the main value lies in EAAA, with IPO being frequently delayed. Do you see them actually following through? Well, we've been following Edelweiss for about a decade, met with them many times over the years. We have not seen management exits. I think that's actually a wrong statement. I think we've seen a lot of continuity in their senior team. Venkat is one of the founders of Edelweiss, and he's stepped down from the CEO role at EAAA. I've met Venkat before. In fact, I've had him for tea here in my Austin home. I think maybe like a year or so ago. So wonderful guy, actually. Like him a lot. I'm not sure why he's leaving, but I don't think Venkat is leaving to go someplace else. There are issues we don't know about, and I hope he's okay. But Venkat himself said that he's all in on Edelweiss. He's got a large portion of his net worth tied up in the company. I met the successor CEOs of EAAA last month in India, both solid guys, and they've been with EAAA for a while. So I do think between the 3 of them, Venkat would have been the strongest because he's just a fantastic manager and founder and so on. But I was impressed with the next crop coming in. And EAAA is a very good business, but I think they've got other gems in their portfolio which will reveal themselves over time. So we don't have much of a concern about, I don't think the IPO will get delayed beyond 26. So I think that will go through. Are you going to be able to let your winners run given the fund restrictions around position size, number of holdings? We've set up our portfolio in compliance with all the rules and laws, and we like the mix of things and how we've done it. For example, we've got approximately 10% of the fund in the 2 Reysas companies. And if it were up to me, I would put it all into one of them, not both of them. But it's 18 versus 20 difference and that sort of thing. And that's what we've done with a lot of the other positions is we've got more positions, but they're not that far off from where we'd like to be. Warrior talks about the advantage of serving the Atlantic basin because of access to Port of Mobile in Alabama. It looks like they are increasingly going to rely on Asia for sales compared to low-cost producers in Australia, Russia, Canada, Mozambique, the countries where they list competitors. It seems those countries are all better located to sell to Asia. How do you think about this? Well, so in coal transport, it is the land portion of the transport that is the most expensive. Once you get the coal on the water, it relatively doesn't matter where in the world it is. So the key is to get it to a port as cheaply as possible. So with Warrior, they have excellent logistics to get to the Port of Mobile. I spent a good part of half a day at the Port of Mobile a couple of years ago, and I think that's a fantastic facility and asset, created by the government of Alabama for trade, etc., with coal and other commodities and other things coming in. It's a great infrastructure they have there. So I think Warrior is very competitive globally with their coal. The coal is very high quality. And I think that in 2020, they actually had a schedule. The longwall is going to start producing coal in a few months, early 26. And by probably early 27, they'll be fully ramped. So their production would go from something like 8 million tons to about 12 million tons. And Warrior has the possibilities to take their production as high as 20 million tons. It would take a couple of years, 2, 3 years to do that. But if the rates went crazy, they could bring on a lot more production. I mean, they would shrink their reserves and the company would run out of coal faster, but they could kind of move that forward on the curve if they had to. So we like that bet quite a bit. Question on Edelweiss. Can we consider a bet of Edelweiss as a bet dependent on corporate action to take place? If yes, what is the possible wait time without any action? Yeah, I mean, I think the likely situation with Edelweiss is that as the individual assets get a valuation, eventually that valuation will get reflected in the mothership. And we saw the same situation, like I talked about Nuvama pre-IPO, and how it was sitting on an asset in 2021, which is today valued at $3 billion, and that was nowhere near reflected. And I think EAAA, even though it may IPO at $1 billion, $1.5 billion, or $2 billion, when we look at it 5 or 10 years from now, it's going to be a huge multi-billion-dollar company. And so I think, like I said, nothing is guaranteed in the equity markets. I think we like the asymmetric nature of that bet. I think the odds are favorable. And beyond that, we'll see how it goes. What do you think about AMR's management selling part of the shares in the company? Well, one thing I think to keep in mind about markets and people buying and selling is people buy stock for only one reason and they sell stock for 100 reasons. So the signaling you can pick up when someone sells something can be way off. And I would say that Alpha, their chairman now is Michael Gorzinski. I've met Mike a few times, and he's a first-class capital allocator, understands the coal business really well, has a large stake in Alpha, and he's a very much an owner mindset. And a lot of the managers I've met with, I mean, they are really, really some of the best in the industry. I think the reason that Alpha's moved down the cost curve is because of Jason, their chief operating officer. I think Jason may be the best met coal, continuous room and pillar miner in North America. Really exceptional. I mean, just always enjoyed interacting with him. I think he's fantastic. So Alpha has really good management. I like those guys a lot. And I don't have any concerns about, them lightening I think there's plenty of ownership on the board and in management of Alpha. In regard to TAV, and I'll make this the last question because we've got like 2 minutes left. In regards to TAV, it is partially owned by the French government. Are you concerned with irrational shareholder impact that government may have other interests in stake? Well, Airports de Paris is a 46% stake in TAV. In many ways, when I look at, the former CEO and chairman of TAV, Sani, he's exceptional. He's not with the company anymore. But Sani was a very aggressive guy. I mean, aggression is great. In many ways, he was the accelerator. And the French, a lot of the civil servants from France who were on their board, they were the brakes. And so, in my opinion, it was a great fit because you had kind of a tension between them. But I think that the investments that came out at the end of that were exceptional. I mean, they made the Almaty bet. They signed up for the Ankara deal. I mean, they made some very big bets. These were not timid bets. And so both sides basically, came at it differently. So I think the French have been very good, kind of sobering influence. The French have a very conservative approach. They want TAV to have a conservative balance sheet. I'm all for that. And they want TAV to be a strong dividend player, but they also understand that once TAV, they got levered in the last few years because of all the different deals they were doing. I think in the next few years, once they get the leverage down, they will once again start looking at interesting opportunities around, and they may step up to the plate. So I actually don't see the French as being anything negative. In fact, I almost think that they're actually a net positive having them there. And I think they're very high ethical owner, and I think they improve governance and ethics with that company. So I think that's wonderful. And I think I've gone 1 minute over. So thank you so much for participating, and thank you for being investors. We'll talk to you again in about 3 months. All the best. Thank you.